Right, so on our final panel, we're going to be talking about what do intermediaries need to know about net zero. Intermediaries in the audience or people who aren't necessarily fund managers, can you stick your hands up if you're completely confident talking about net zero? No, confident talking about net zero with clients and you're happy having conversations already. Of course you are, Richard, obviously. Silly me. So there are some, which is great, and another gentleman here. Brilliant. So some people are confident talking about this. I think a lot of people aren't. So we're going to strip this back to basics a little bit and just hopefully make it so that you're a little bit more comfortable having those conversations and getting people to know what it is that net zero is about and why it matters. So, without further ado, maybe I should, what order are we going to, we're in the same order again, that's brilliant, thank you. Can I start by asking Christopher, can you just introduce yourself and the funds that you're involved with and basically what you do? Just.
My name's Chris McGoldrick. I work at Stewart Investors, and I'm most concentrated on working on the Asia Pacific Leaders Sustainability Fund.
Yeah, so I don't think your name was very clear, although it's there, but so Stewart Investors, I think your mic cut out very briefly there. But just, these lapel mics are a mixed blessing really, aren't they? So thank you. Do you want to talk about what funds and, you said, sorry, I was worrying about your mic there.
Hi. My name is Chris McGoldrick. I work at Stewart Investors, and I concentrate my daily activities on the Asia Pacific Leaders Sustainability Fund, which is probably one of the largest and oldest sustainability funds investing in the Asia Pacific region in Europe.
Thank you. And David?
So my name is David Harrison. I work at Rathbone Group. I'm the manager of the Rathbone Green Bank Global Sustainability Fund. It's a global stock-picking fund. We launched about 4.5 years ago, and we work very, very closely with our colleagues at Rathbone Green Bank Investments.
Thank you. And Samuel, please.
Good afternoon. My name is Samuel Mary. I work as an ESG research analyst at PIMCO, where I lead our research on climate change, and I'm also one of the portfolio managers of our climate bond strategy, which focuses on high-quality green bonds, climate leaders, and broader climate solutions.
Thank you. And Joe?
Perfect. My name is Joe Horrocks-Taylor. I work for Columbia Threadneedle Investments, and I'm a biodiversity and climate specialist. I kind of sit within our response investment team, so cover the kind of swathe of Article 8 and 9 funds, which we run and manage, which is about 42.
Okay. Wow, that's interesting hearing them being described as the swathe of Article 8 and 9 funds. They didn't used to get called that. But yes, okay. And we'll probably have a whole load of new labels coming at this time next year that we refer to them as. Yeah, including the stewardship funds as well, which are the funds that I was involved with, which no longer go by that name. But there we go. So, okay, who's going to volunteer to kick off with what net zero actually is? Can we have a definition for something? David, you're smiling. So let's go. Or was that, please don't ask me.
I think it'd probably be very similar, I guess, all of us. I mean,
yeah.
I suppose the way I think about it is, in most simple terms, it's, the most important piece is a company, economy, industries decarbonising what they do, the core operations of what they do. And for me and us, that is the biggest part of it. So that's kind of the lion's share is making things less carbon intensive, and the other side being taking carbon out, which I think is a lot more controversial. I'm sure we'll come on to that, whether that be carbon offsets or carbon capture or investing in a wind farm to offset what you're doing. That's how I think of it, and we see, I guess, all flavours of that when we invest.
Okay, so Christopher, maybe do you want to come on to perhaps the difference between net zero and aiming for absolute zeroness, or just to give it context to those people who are perhaps a little bit less familiar, because they're not quite the same thing, are they?
Yeah, absolutely. I mean, I think the biggest problem with the term net zero is the word net. We should be aiming for zero emissions and as quickly as possible. We should be pushing companies harder and faster to achieve the goals of zero emissions. The net implies an offset, and as we all know, those offsets are imperfect in nature. And the quicker we can push companies to get to zero emissions, the better for all.
Just use your better energy sources in the first place. Yep, Samuel, did you want to add anything to that? Just to set the context, what we're talking about here, in case you've got a different take on it.
Yes, but perhaps a couple of comments. I think the first one, building on what has been said, is the topic of the rate of change in terms of decarbonization. So how aggressive it is to be consistent with the carbon budget and the Paris Agreement on climate change. And maybe the second important aspect to also constantly highlight is the connection with the Paris Agreement and the policy agenda. Because net zero was initially a concept that was framed in the context of the global objective, and what policymakers, as part of their commitment to the Paris Agreement to keep temperature rise within the 1.5 degree by the end of the century, would essentially have to do. Subsequently, this net zero concept has been adapted or translated into a methodology, a framework, a pathway for companies, for investors, for portfolios. And all of this is a work in progress in terms of guidance, in terms of actual decarbonization rate, precisely. And therefore, it's important to sort of focus on the best practices in relation to the translation of this goal in a portfolio context.
Yep. And particularly if you're investing, if you're talking about sustainable funds, those ones need to be leading the pack, right? They've got to be the better ones, which sometimes gets, I think, a little bit lost. Joe, would you like to?
Yeah, I guess in terms of how this applies to investors as well, you often see investors on a bit of a continuum between kind of focusing on reducing portfolio emissions and then also trying to support the transition. I think you can't really kind of have one without the other. I think at the moment we're seeing a kind of more of a blend of approaches start to emerge. So if you kind of purely focus on reducing portfolio emissions, it's kind of purely a carbon accounting exercise, and it's very easy to do. You can kind of sector shifts, you can invest straight in leaders, you can really kind of quickly reduce emissions to align with the Paris Agreement, but actually it doesn't really have much real-world change. I guess kind of building on what the panel before we're talking about, I think we've then seen a lot more focus on stewardship and how actually kind of supporting the transition can affect some of that real-world change, but then obviously there needs to be the kind of objectives, timeframes, all very clearly laid out so that we can avoid some of those accusations of greenwashing and kind of endlessly speaking with companies without any real outcome. I think now you see kind of investors starting to position themselves somewhere along that. I think our position as Columbia Threadneedle has probably been slightly more towards the engagement, stewardship, solutions angle than possibly other investors who've been a bit more kind of focused on stringent portfolio decarbonisation targets.
But different strategies within different funds, right? So for the audience here, you know, rest assured there are plenty of funds there that take it really seriously. So let's come on to that then. So what your companies actually specifically do, and if it's for a particular fund or for your house, as in company. Do you want to describe a little bit, Christopher, on what options you offer for clients who are interested in net zero, want to get to net zero, what the funds are doing, and also wider company-wide activity?
Well, we have Asia funds, European funds, world funds, and they all follow the same philosophy. And that's always precluded investing in low-quality companies. And we define companies which are harmful for all stakeholders or any stakeholders as being low quality, so we haven't invested in them. And we don't have multiple strategies doing different things, which seems rather contradictory.
Brilliant. David?
At a group level, Rathbone's group, particularly in the past 3 or 4 years, fully embedded with commitment to net zero and embedded the science-based targets across a lot of the portfolios. So we have a very strong kind of group framework. I'd say within that, the area I'm involved in, we have a range of sustainable funds. We partner with Green Bank, and I think it's been raised already, but a lot more stringent, in terms of our ethical framework. So what we do in the areas of engagement, that's a big thing of how we think and we invest. So I'd say at a group level, robust framework, but then very strong specialisation in sustainable investing.
Okay, and so does that mean you're doing work around the companies that you're investing in your specialist portfolios? You're treating them slightly differently? You're holding them to higher standards, or is it much the same? Or? Yeah,
I'd say that there are accelerated timescales and higher standards. So to give you an example, with the science-based targets, where those sustainable focused funds are, they're much higher already in terms of embedded with the companies we invest in and what we expect from those companies, but it's still in the wider framework. But so for the right kind of, a certain kind of investor who wants that more stringent and accelerated timeline, that's kind of where they'll come to us. So for your funds, you're going to be pushing them a bit harder, and then that information is disseminating out a bit more? Absolutely, but I think it's really important that we have the same overall framework across the group. Yep. And Samuel, would you like to talk about what you do, your company-wise and your fund-wise?
Sure. think it's important to start with the distinction between two perspectives for PIMCO. The first one is our ESG optimized portfolios, including for clients that have climate-related or broader ESG objectives, where we have developed a net zero framework and built on our broader ESG framework and a number of optimizations that we have been undertaking for many years, such as decarbonizing portfolios, allocating capital to climate solutions, or engaging with issuers. And the second perspective is firm-wide. We believe net zero is a very key trend that is going to have implications for markets, whether they have climate-related objectives or not, given the number of commitments that have been made. As it relates to the first pillar that may be more directly connected to today's discussion, we have developed a net zero framework that is comprised of 4 main pillars that we believe are essentially connected to all the emerging frameworks and pathways translating this net zero goal into a portfolio objective. And that includes, obviously, the reduction of carbon emissions associated with the portfolio, building on best practices in terms of carbon accounting, robustness, and the connection with real-world decarbonization. Secondly, in terms of levers or potential additional targets, the focus on climate leaders, essentially issuers that show best practices in terms of commitments and consistency of their business model adjustment with the net zero pathway. Thirdly, climate solutions, which are key. In a fixed income context, it typically revolves around green bonds, but it's actually, in our context, broader than that. There are many issuers with exposure to renewables or energy efficiency that may not issue green bonds for various reasons and have a role to play in such a portfolio. And the last one is engagement, which we also believe is essential, so as a backbone of this process, in order to encourage issuers in terms of disclosure and data that are needed to support our net zero assessment, or in terms of actual transitions. So we have emphasized what are our recommendations, expectations, and what are the key themes that we subsequently engage on to drive portfolios in this direction.
Okay, thank you. Joe, and obviously you work for a group that's got a wide range of options as well, so do you want to describe those a bit?
Yeah, sure. So I guess in a similar way to the kind of fashion the other guys have described, I think we have a kind of firm-wide approach, and we kind of layer on more of our kind of bespoke strategies on top of that. So kind of at the firm-wide level, I think there are a number of different angles which asset managers can go down. This kind of science-based targets, net zero investment framework, and net zero asset owners alliance. We've kind of gone down the net zero investment framework, and that's how we've kind of structured our net zero targets at the fund level. So at the fund level, each fund has 2 primary targets. The first one is to decarbonise in line with their market benchmark, reducing by 50% financed emissions by 2030, which is aligned with the 1.5 degree trajectory.
50% by 2030?
Yeah. So that's the kind of, I guess, kind of hard target we commit ourselves to. And then the other one is more of an engagement and alignment target. So we have a kind of proprietary net zero model internally, which we use to kind of like rate companies against a number of different metrics, drawing in different data sources. And then we can rate whether companies are aligned or not with a kind of 1.5 degree trajectory. And we have a target for 70% of our funds holdings by financed emissions to be either classed as aligned or we're engaging in that proactively. So this is really just a kind of prioritization exercise for us to be able to identify the companies which are making up the most significant portion of a portfolio's financed emissions and making sure that they are either classed as aligned, so they're already there, they're committed, they're in line with net zero, or we're proactively engaging them. So this just means that rather than having an engagement target at the kind of overall company level, we have it at the fund level, making sure that when a client invests in one of our net zero funds, they are investing into that kind of very active engagement at the fund level as well.
Because you're going to have to be disclosing on a fund level in due course anyway, so it makes sense to focus in on the funds rather than company, yeah. That was my next question, was around your framework and you know, what do you call it, how does it work, what are the mechanics of it? Did you want to say anything more on your specific framework you talked about? Sorry, the name's gone out of my head. Net zero asset management?
Net zero investment framework. Yeah, so I think there are a number of different frameworks on the market, as I kind of mentioned, which we're seeing different asset managers take into account. I think we decided to go with the net zero investment framework, mostly because we were involved in actually designing it from the start, which always helps. But it had a very clear focus on that kind of engagement element and then also the kind of climate solutions, both of which we feel are kind of quite key to be able to kind of show that we're driving that real world change. It does have the kind of hard level decarbonisation element as well, but that's a kind of guardrail, I guess, and isn't so intrinsic as like a Paris-aligned benchmark or something, which have very stringent climate targets, which can sometimes prevent funds from engaging and actively owning companies which maybe are slightly in higher emitting sectors.
So it takes you away from being able to have the conversation?
Yeah.
Okay. Samuel, do you want to talk about frameworks and structures and how you work, the mechanics of it, the nuts and bolts of it? I mean, talk about if you are linking through to different initiatives. Can you just get back to, what can these guys expect to see in your literature saying we do this, this, and this? Do you want to describe that a little bit?
Sure. So the net zero framework that we have built is essentially connected or building on all the existing available initiatives, and the main ones in our context are the Net Zero Asset Owner Alliance, given the fact that many of our clients are part of this one. Secondly, the Paris-Aligned Investment Initiative that is connected to the Net Zero Asset Managers Initiative, which we have been also involved in terms of development of methodologies for sovereign and corporate bonds, that are particularly relevant to our context. And the third one is the Science-Based Target Initiative, which has developed also frameworks and methodologies for the finance sector. So the four pillars I have described can essentially be connected, and what's important also for us is to have this framework that is flexible, because we appreciate that our clients have different goals, different preferences in terms of frameworks, and in terms of interpretation of what it means in practice. Because these frameworks are partial, in a way. As it relates to the implementation, there are a number of questions in relation to the metrics, in relation to the scope, and so on. So we are there to help them and guide them in terms of concrete implementation. Then maybe a second quick remark is that for climate bond strategy, that is a fund we created and for which we had already a focus from the start on decarbonizing the portfolios and strong and best-in-class climate characteristics. We have actually built on several frameworks that constitute best practices to build our own dashboard to understand the extent to which we are aligned with net zero pathways and are taking steps towards this journey. And that includes the frameworks I just mentioned, so SBTI or Paris-Aligned Investment Initiative.
So again, tracking it like David was talking about earlier. Is there anything, would you like to describe your framework? So what does someone, if they're getting a piece of paper that describes it and they've got to sit and talk to a client about it, what do they get from Rathbone?
It's very similar at a group level. Science-based target initiative, that's at a group level, that is a key thing for us, but also the Net Zero Asset Managers Initiative as well, a kind of key overarching at a group level. I'd say, similarly on our fund, we go much further. So we do something called the annual review, which will show the full carbon intensity of the fund, the pathway of that carbon intensity, and then we show all the underlying holdings and how we get to that data. So that's kind of, I think our investors in our strategy, that's what they really like, the transparency. So actually what it means for that individual investor, they can see exactly what they're holding, why, and how we got to those numbers. So in terms of the frameworks, I think very similar, but on our strategies, I think just very much enhanced transparency and disclosure.
Cool. That feels like quite a good in for Stewart to talk about that kind of thing too.
Echo those last words. That's very much the approach we've taken, is radical transparency. We have a wonderful net explorer which allows clients to look at every company, and we've detailed the pros and cons and their carbon emissions and the topics of engagement with these companies, so that clients can decide for themselves whether we're being genuine to what we say we do or whether we're being false in order to accumulate assets, which sadly this topic has lended itself to. We don't really have lent ourselves to frameworks for the simple reason that our philosophy has precluded investment in noxious companies from the last 30 years. So when we look at our carbon emissions, we're somewhere like 80% below comparative benchmarks. We've never invested in our company, and we can track it over the last 5 years. So we've actually adopted some of our own methodologies, which is not marking our homework. We've agreed with the project Drawdown, which is to map all our companies which are actually contributing to reduction of carbon rather than limiting the pace of emissions into the atmosphere, which seems to us much more consistent with our philosophy. A lot of these frameworks, the alphabet soup, that is, these frameworks seem to be a bit of a distraction.
Yeah, and there are those people who talk about whether or not they will last, because once the pennies drops, and I do find, in my experience, a lot of the companies that were doing this earlier than other companies have kind of looked at a lot of these frameworks and said, what exactly does that offer me? Because we were doing it already. But they've been fantastic in getting a lot of the firms that perhaps weren't in the area 20 years ago to get started and to accelerate. But the future of them has got to be, well, who knows? It may or may not work.
There's going to be rationalisation of the frameworks. I mean, it reminds me of accounting standards way back in the day when we had a proliferation of accounting standards and gravitate towards one or two. Sadly, it seems to me that a lot of these frameworks are just ways of people ticking a box or signing a form, which is in order to rather accumulate assets rather than do what the framework's meant to do.
Hence the greenwash allegations, hence the criticism of the sector that a lot of us have tried very hard to make as transparent as possible, and other people are, yes. But hopefully that's what the new rules are about. So it's, okay, we've got all these people interested, let's all move forward together now, guys. So, but time will tell. Can we come on to maybe the other aspects? Has this information hit through to investors that what we've got to do on decarbonising? Has it affected share values yet? Has it affected markets? Are people really thinking about this stuff beyond, our circle? Do you get a sense that it's doing anything?
In my very humble opinion, I think the topic of decarbonisation and net zero risk crowding out so many other more important or as important topics. The interconnectedness of sustainability issues are such that you can't just think about climate, you have to think about human development. You have to think about biodiversity loss. Coming from investing in Asia, Asia's sadly there's a pinnacle of these development challenges. It's impossible to go there and not see pollution or obesity or litter or climate change. And just focusing on climate is risk crowding out proper consideration of other factors that are just important for investment. So identifying market movements just based on climate, I think, is a false god.
Okay, sustainability more generally then? Do you get the feeling that that's moving markets yet or not so much?
It's something that is becoming more important, should have always been important, but is becoming more important, and you see that in the way that companies are responding to us. Sadly, it's not only asset managers but greenwash, it's also companies that do so. And actually, in a way, it's becoming a lot more obvious. The thicker and glossier the ESG document, sometimes the easier it is to see that they're not genuine to their beliefs.
Yeah, Shell used to send me their sustainability guide for years, or sustainability report. It's just, they spend more money on it, the worse companies are. David, do you want to come on to that, feel about how it's hitting the markets, how it's being received? Because, and if any of you know anything about what's going on in Texas, where people are being forced effectively to finance this stuff, because to me that's a sign that we're actually winning to some extent. At least some people are getting angry, which is better than everyone ignoring us, I think. But David, do you want to talk to this?
I think I would echo a lot of the points been made on net zero. I mean, the one thing about there are so many other important issues as well. We have seen, I think, particularly in the US companies that starting along this journey, just commitments, it might be to science-based targets or a commitment to net zero. I remember 3 or 4 years ago, you'd be laughed out of the room sometimes, and that's a step forward. But I think you have to be honest that we'll start with a very, very long journey. So when we speak to companies and management teams that we think are very capable in terms of allocate capital, they're very honest with us. It's like we don't know where this goes. We'll be very transparent with you. So I think there is progress, but I think to the point before, this is only one of the considerations when we think about it as well. So it can't crowd out other points.
Yeah. Okay. Do you have thoughts on this, Simon?
Sure. I think on the market implications, I would agree it's important to obviously connect climate-related trends with broader sustainability trends in terms of synergies and trade-offs more broadly. I also think it's important to take a step back because to some extent net zero is a fairly recent concept, but the decarbonization journey, the transition risk or the materialization of the risk associated with energy transition is not new. So when we think about the impact of net zero on markets, obviously we look into a broader framework to analyze from top down to bottom up what the energy transition means in terms of capital flows, in terms of business model changes. And there have been already a number of instances in some industries that are a bit more advanced in their journey, such as utilities or the car industry, where they have taken steps towards, to some extent, for some companies, pathways that may be closer to net zero. And this has had an impact. Secondly, governments that have also taken actions in terms of tightening carbon policies, notably in Europe and increasingly in other markets. The net zero movement, to some extent, if we think about some examples such as the EU or the US, policy response to the energy shock have basically signaled that there will be an acceleration in the energy transition, partly in order to advance their net zero objectives. And these are trends that matter for portfolios that have climate-related objectives, as well as portfolios that don't, because there will be likely implications for the holdings, being governments or corporate issuers.
Yep, I think that's right. The implications are wide, aren't they? Joe, would you like to talk about your view on market implications, and then perhaps if you could then fold that one into the next point, which would be about, can you describe what you do for an escalation strategy? Because people like us talk about it quite a lot, and my suspicion is that most people don't really know what an escalation strategy is or what it looks like. So you want to comment on markets a little bit if you think we've missed anything, but otherwise then take it on to the point about escalating, when things aren't quite going too well. What do you do?
Yeah, sure. Maybe a couple of quick points on market influence, I guess. One of the big ones I see is that there have been obviously a lot of new markets spinning off, like things like EU ETS trading or like the voluntary carbon market as well. There's been that kind of growth of new pockets as well, and that always seems to be growing. But I think the actual influence on kind of like core public markets is stronger in some geographies and sectors, as we touched on. Kind of examples like Tesla and Orsted are kind of changing up those kind of quite specific sectors quite rapidly, and that's obviously a really strong sign. But there's still a lot of kind of academic research which shows that a lot of net zero climate risk still isn't really priced in. There are some kind of short-term policy-related risks which are getting better at being priced in, but the kind of rest of the swathe of net zero and climate risk element isn't still really quite there yet. I think a lot of that kind of comes down to some things we've touched on a few times, which is the kind of quality disclosures and data, which makes it hard to incorporate, and then also, I guess, it's kind of understanding and how asset managers can kind of communicate those net zero trajectories into kind of real financial valuation modelling. And I think that's where it becomes more and more important that PMs, fundamental analysts, are playing this into their valuation models directly.
Which is the materiality we touched on a little bit earlier. But yep. And so, okay, so probably a little bit early stage for us to be saying this is definitely shaping markets just yet. I think we're probably broadly saying, but there are areas where it's starting to have an impact. It's being taken more seriously. And actually, to the wider point, so net zero, the other stuff that we talk, like biodiversity, is clearly equally important. But one of the things I like about net zero is it's become very high profile, so people are starting to talk about it. So it gets it on the agenda in a way that perhaps we just couldn't 5-10 years ago, because people just had a good laugh about what we were trying to do. So I think it's helped to escalate that. But so when we're talking, so from your perspective, Joe, if you're talking to a company and you're thinking that they're heading towards net zero, it's really early days, okay, because we haven't been talking about this for that long. But do you have a sense of how you're going to progress it if it looks like they're not doing all that well?
I think at the start it comes down to kind of what constitutes kind of good engagement rather than just kind of net zero engagement.
Yep.
I don't want to kind of,
it's wider. Yes, true.
Replay everything from the previous panel, I guess, as well. But I think a lot of it is trying to work out why a company isn't progressing on net zero. For some, that might be a lack of understanding, for example, and then that kind of shapes the role which you take on as an investor engaging with them. So, for example, there are some emerging markets companies where maybe we'll try and play more of a supportive role, kind of point them in the direction of best practice, kind of review documentation, like really try and kind of guide them in the right direction and provide that kind of more supportive role. For others, the reason they're not progressing might be because there are kind of internal blockers, it's a cost point, or even they're just not really aware of its kind of materiality to the company's existence. And then we might need to get a little bit harder, heavier-handed. I think one of the core things for kind of escalation strategies is kind of really setting kind of clear boundaries around the engagement. So what are your objectives? What's the time frame that you're looking to achieve those objectives over? If we're engaging with a company and we set an objective and the timeline elapses, then we'll look to move into some of the more kind of iron glove kind of routes that we might want to take. So I think in the first instance, that would be kind of trying to engage with our fellow investors as well, making sure that we are all kind of pulling in the right direction, in the same direction, through initiatives like Financial 100+, for example. Then from there, we might look at things like writing public letters, trying to liaise directly with NGOs, that kind of more kind of public pressure building, which we can play as that kind of much more kind of like activist owner. And from there, I think then the next step up is into the kind of voting side of things and into what we can actually do at AGM season. I think when directors' roles are on the line, that's when often they'll really start to take notice. We've really tried to kind of build that very strongly into our climate voting policy. We've had that for about 3 years now. Each year we've tried to kind of ratchet it up, what our expectations are, how many votes against management we will kind of put in place at companies where we don't think they're progressing fast enough.
And having obligatory reporting with things like TCFD, is that going to help that process?
I think it definitely helps, and I think it also it helps with the targeting as well of these types of votes. I think one of the things we're trying to do is to, obviously you can target the director who chairs the Sustainability Committee, for example, is a very obvious one, but now with the rise of TCFD, we can have a more stronger rationale to target people like the CFO, the chair of the Audit Committee, even the kind of independent auditor re-election, like things like that. We can really try and zone in into those more kind of financial material elements, which can hopefully kind of pivot the company a little bit.
Cool. Samuel, would you like to talk to what you do when things don't look like they're going so well? It could be in your climate bond fund, or it could be more widely as an organisation. Just say which.
Sure. I think perhaps on
It's
this
obviously a
topic,
bit different for bonds, maybe, but yeah. So talk to what you do. But sorry.
yeah, sure. I will probably start with that, why it's different for bonds. Because a lot of the engagement frameworks, and historically, the engagement taking place in the ESG industry were connected to listed equity. The first message that we have been constantly emphasizing is the role of bond markets and the specific characteristics of bond markets in terms of issuers being repeat issuers, in terms of our ability due to our size to influence them, in terms of role linked to specific instruments such as use of proceeds bonds, so bonds for which the proceeds are used for climate-friendly projects, for example, or more recently bonds for which the financing conditions, for example the coupon step-up, may be linked to a decarbonization target. So all these elements provide a specific environment. There are also some private issues, so for which the level of disclosure will be obviously typically more challenging. So we have developed our engagement framework and have been very active across these different segments to communicate what we see as best practices following our process, and that involves the topic of the escalation policy. So our priority is obviously to foster the bilateral or collaborative engagement in a structural fashion with issuers. If the progress over time may not be sufficient, may not be reflecting what was initially expected, there is a process whereby we look at a range of options. The first one being the elevation of the communication with the issuers. So typically, many of these conversations would start with investors' relation, the sustainability department, and subsequently can be elevated to the management. Secondly, the topic of the potential impact on investment decisions, being holding or suspending the holding or the future purchase for one particular issuer, or potentially considering a divestment. What's key in our dialogue with issuers in relation to this escalation process for us is to constantly highlight that this does not only matter for ESG portfolios. We have our ESG investing framework firm-wide. We have our ESG integration whereby credit analysts are directly evaluating the ESG quality of issuers based on our scoring framework. If there are some issues that are raised in relation to this engagement, and these are material issues connected to these issuers' business and credit quality, then that could have an impact on this ESG score. And this ESG score is incorporated into credit research and subsequently an information available to all
across the board. Yeah.
And we feel this is quite key to constantly highlight this connection with our credit evaluation and the fact that this is not only a sort of sustainability or ESG-related dialogue.
Okay. And can you talk to, so Mylin touched on this a little bit earlier, but can you touch on the, if you've got a bond which is labelled as being a sustainable bond, a green bond or whatever, can you talk at all around what you do to make sure that that's what those monies are actually used for? Do you have processes in place for that? This is a genuine question, I don't know the answer to it.
That has been a key area of focus for us. So that has led to the development of an assessment framework. So we have the ESG assessment at the issuer level, and we created a framework specifically to evaluate ESG labeled bonds based on various components, so including the strategic fit, so essentially the consistency between the objectives of the bond and the broader strategy of the issuer. So if a utility is issuing a green bond, obviously the shift from fossil fuel to renewables, if the bond is financing renewable projects, is key. Secondly, the evidence of net positive outcomes associated with the projects that are financed. And that's straightforward if you think about historically the first green bond that we're targeting, electrified passenger railway or wind and solar that tend to be classified as dark green. But we have seen a growing number of bonds linked to activities or projects that may not be, maybe more ambivalent.
But you need to be confident, don't you? So, yeah, confident, that's what they're doing.
We need evidence. Maybe it's the topic
Evidence,
of real economy decarbonization.
Yep.
We need evidence that there is actually a deep emission cut that is associated with the renovation of a building, for example.
So prove it, yeah, which is what's going to come through. And that's when Sashi was talking earlier about the chain, is how it works through the chain. We've got to get all these different levels of proving stuff as they go along. And certainly one of the conversations I've been having with the FCAs, it doesn't need to be 10 million data points every time. It's just got to be, we can see they're doing this. We can see they don't do that. So kind of that's job done. And hopefully that's the way we'll go. But brilliant, sorry, thank you. David, do you want to talk a little bit about escalation, how, the real relationship bit?
Yeah, so I think that, it's already been mentioned very well, but we have a clear escalator, around, if particularly think about net zero, I think it'd be very similar to what we do on other issues that come up with management teams. So firstly, if you've identified something, engaging with them, going back, and if it's not remedied, engage again, voting, and ultimately it will be happy to divest. The one thing I'd say that we're doing already in this space, though, is that we're being quite proactive. So I know we've identified 50 companies who are more carbon intensive, and then already speaking to them. And I know the ones that there's a few of those that we own in our strategy, and that's been very, very powerful because you can get an honest assessment from management teams that this is a really big issue. And they're happy to kind of share best practice with what other companies are saying. But for us, then, that allows us really to kind of get a very good idea now. So in 5 years' time, if the story changes or something changes. I think the other thing that is a big red flag for us is, what now is becoming easier to track is when a company invests new capital in a new area, if that area is not towards the goal of net zero, that's something we're focusing on a lot more. So, long answer, sorry, but it's kind of that. I think that proactive piece is really important for us as well.
Yes, I think that brings us back to kind of the common criticism of oil companies are spending more on advertising their green potentials than they are spending on actually investing in the solutions that we'd like them to be shifting towards. Christopher, would you like to comment on this as well?
Yeah, I'm very curious about the term escalator. We only invest in high quality companies that are sustainably minded. So our starting point is one of alignment. So radical engagement is not part of our process. We're only trying to iron out imperfections. We strongly believe no company is perfect. So escalation is probably repetition and partnership with common-minded individuals where we have an ethos or value system that is aligned but may have a different opinion on what's important. So escalation, as I say, would be more repetition. That said, there are some topics that we cannot do on our own. One of those would be mineral content of semiconductors. We recognise that having conversations with that very powerful industry on the provenance of their minerals, we were insufficiently capable of engaging properly. And thankfully, we were able to collaborate with the industry to try and have a stronger voice on that. And I suppose that would be an example of our escalation, but most typically our engagements are more progressive or friendly and much longer term.
Yeah, and I think that's one of the areas, isn't it? Especially with net zero, it's quite early days on a lot of this. And even talking about biodiversity, I mean, we just called it nature before, but now it's, it can be either or. But, this stuff is not going to get solved overnight. Supply chains and everything are messy. And that's really great, thank you. Can I just ask if you've just got one thought for each of you or any of you, that if you're an intermediary or someone who works doing services for retail investors, if they were talking to someone about net zero or climate change, or frame it how you like, what's the one thing you think they ought to be saying and mentioning? Is there anything particular that stands out they should take away from this panel or from anything that you do otherwise? Christopher, would you like?
I'd say it's not a panacea. Net zero is one of many objectives that we need to try and realise, and the term, whilst complicated in certain aspects, shouldn't crowd out proper, high-quality, long-term investment.
David?
I'd echo that and say this is going to be a long journey, and slow and steady is better than rushing. And it's likely to change as well. You know, someone made the point, this is all quite relatively new, the term net zero. You know, 5-10 years time, it will change, but I think it comes back to thinking about the kind of companies you want to invest in. You know, I think the word partnership's been used before, but actually, you know, that's kind of going to be key, and that long-term relationship.
Yeah, maybe we'll start questioning properly the use of the word net, eh? Who knows? Samuel?
I think it's probably important to emphasize that it's a relatively complex topic, hence the importance of having a holistic framework. There is no pure and perfect indicator that will summarize whether a portfolio is net zero aligned or not. There is a need for a combination of factors and dimensions to look at. And secondly, also important to keep in mind the sort of science on the back of all these discussions. So we are talking about greenhouse gas emissions, that's the ultimate goal. So it has to be evidence-based, it has to be connected with this global policy agenda and what it's essentially telling us. And thirdly, the question of transparency, which I think was brought up in the previous session, is obviously key. And transparency means obviously evidence of actions being taken to move along this journey, which may mean engagement updates on the actual developments and the actual steps taken accordingly.
Thank you. Joe, final word from you?
Yeah, I think the transparency point is the kind of key for me, really. I think there are so many different solutions, kind of marketing campaigns around different funds that now it's the time to kind of like try and cut through that, I think. And it's a really exciting time at the moment as well, because I think there are a lot of different strategies which can appeal to a wide variety of clients, transition funds, solution funds, kind of really strong Paris-aligned benchmark rated funds. Like, there is a real variety, and I think that is in some ways quite a good positive as well.
It is a good positive, but I think, you know, come back to Christopher's point at the beginning, you know, just anything that makes people think it's dead easy is just a hostage to fortune, because none of this is easy. This is all complicated. It's part of a mosaic. These are all different things that have got to come together, which is why one single data point used on its own can be terrifyingly misleading, whilst we know that people have got to measure things. So it's a complicated area. Thank you for helping me pull out the net zero bit, because I wanted to focus on it a little bit, because we're going to be seeing so much more of it over the coming years, and hopefully in due course we'll drop the word net, but who knows. And with that, I'm going to say our next our next thing, if you like, is to go and grab a cup of tea or coffee, which we'll be doing 15 minutes downstairs, so 15 minutes off. But if we could thank the panel first, please.